Welcome to our quick dive into the Elliott wave principle, a powerful tool used by traders to analyze market trends. Today, we're focusing on the cornerstone of this theory, the impulse wave. So, what is an impulse wave? In simple terms, it's a strong, directional move in a market's price that aligns with the main trend. Think of it as the market's way of charging forward, whether it's an uptrend or a downtrend. The Elliott wave principle, developed by Ralph Nelson Elliott in the 1930s, suggests that markets move in repetitive patterns called waves. An impulse wave is the driving force behind these patterns, and it always consists of 5 distinct waves, labeled 1, 2, 3, 4, and 5. In an uptrend, wave 1 is the initial surge upward as buyers jump in. Wave 2 pulls back slightly, correcting the move but not erasing it. Wave 3 is the powerhouse, usually the longest and strongest wave, where momentum peaks. Wave 4 is another corrective dip, setting the stage for Wave 5, the final push higher before the trend pauses or reverses. A few key rules define an impulse wave. First, waves 1, 3, and 5 move in the direction of the trend, while waves 2 and 4 move against it. Second, wave 3 cannot be the shortest of the 3 impulse waves, 1, 3, and 5. And third, wave 4 should never end in the price territory of wave 1. These rules help traders identify and confirm impulse waves in real time. Why does this matter? Impulse waves reveal the market's primary direction, helping traders spot opportunities to ride the trend. They're like a roadmap for understanding where prices might head next. That's the essence of an impulse wave. Keep studying those charts, and happy trading.